Hi everyone, this is Prashad Parthiban. Today I'm going to explain differences between surety claims versus traditional insurance claims. You may have this question like what is the need of explaining the difference, how it's going to add value. So the way the surety claims are processed is significantly different from the way traditional insurance claims are processed like commercial auto or workers' compensation. So it's very important you understand the difference. To start with the first category, how the payment is made when it comes to claims process. If you see here, when it comes to surety claims, if your claim is paid by the surety company, otherwise the insurance company, expects full reimbursement from the principal. This example, if say you have a contractor who does their job, and if there is a claim scenario, in the loss amount is say 1 million, the surety company may pay 1 million or arrange somebody to complete their work, and whatever the loss amount the surety company is paying, they will expect the principal to reimburse that money to the surety. So traditionally, the surety is paying the claim as a kind of no fee, yeah, right? There is not a kind of loss for the surety. All that they have to do is they have to pay that loss amount and then go back to the principal, and then get that money back. Whereas the traditional insurance claims, as most of us know, it's a totally different way, right? Where the insurance company pay the claim and they do not go back to the first party or third party to recoup that payment. So that is a primary difference between surety claims versus traditional insurance claims. The core thing that you need to understand is in case of surety claims, the insurance company pays the claim, whereas they go back to the principal and recoup that money. Whereas in traditional insurance, it's a loss is loss. That's the reason why the traditional insurance company reviews those past historical claims, etc., to make sure they select good customers who have good history of no having not much of claims. The second difference, as I told you, the surety investigates whether the principal has truly defaulted or explores solution before paying. As I told you, sometimes if there is a contractor who's doing a building job for a government entity, the investigation will be in such a way where, say, if the contractor could not do that in agreed upon timeline, sometimes the surety may arrange an additional contractor to complete that work. It's not like always there will be amount that will be paid to the obligee. Whereas in case of traditional insurance, as most of us know, if there is a claim which has a valid policy coverage, the insurance company will issue the payment. There is nothing like a scenario where you will have somebody to go and look at that and fix the issues. So the second difference, as I told you, in case of investigation process, they will first investigate if the principal have done any defaulting. If that is the case, sometimes they can arrange somebody to complete the work. Whereas in traditional insurance, based on the coverage amount, if it's a valid coverage, then they will pay the claim amount. And the third major difference is like in this case, the beneficiary of the claim is obligee, which is nothing but the third person who is getting service from the principal, like government entities or any kind of company that is employing the contractor or third party principal company. Whereas in case of traditional insurance, the beneficiary is going to be the policyholder or a third party like who got injured due to the policyholder. So that's a third major difference. So quick example is if you see here a contractor fails to complete a government project, right? In this case, a surety insurance company will step in. Sometimes they will complete the project, or in case if there is a reimbursement needed, they will do that. Whereas in case of PNC, in this example, if you have a personal auto policy for some reason the insured's car was stolen, then the insurance company will pay the total amount based on the coverage scenario. So this is all the differences. In short, like no, in surety claims, the insurance company will pay the claim and go back to the principal and ask them to reimburse that money. Whereas in traditional insurance, that's not the case. It's the loss is loss for the insurance companies. Once again, thank you so much for your continued support. Have a great day. Bye bye.